If you've been around for a while, you know that we talk about whole life insurance designed for cash value accumulation now, in the future, and ultimately to leave a legacy. Today we're going to talk about one of the pieces of the mechanics of a whole life insurance policy at a mutually owned life insurance company called dividends, a piece of profit that gets passed along to the owners of the company who just so happen to be the policy owners. Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money. So we look at life insurance as a death benefit, primarily. But there's other parts of the policy that really can be utilized to enhance our current and future lifestyles. And part of it is the cash value, and part of the cash value is the dividends. Now, dividends are really the profits that the life insurance company makes. And you have to step back and realize that if you own a life insurance policy from a mutual insurance company, then you are literally the owner of the company as it relates to your policy. And one thing that Nelson Nash taught me 25 years ago was the fact that the profits of an insurance company will go back to the owner of the company. If it's a stock company, then the owners are the shareholders. But if it's a mutual company, then the owner is the policyholder. So because of that, those profits come back to you, and a dividend in life insurance, key point here, is literally a return of overpaid premium. And consequently, it's not taxable. And then if you take the next step, which is to assign those dividends to be reinvested in paid up life insurance, now you just get an ever compounding cash value that continues to grow with the aid of that dividend.
Exactly. So let's take a step back and talk about, two promises that the insurance company is making you with any whole life insurance policy, whether it's a mutually owned company or a stock owned company. The insurance company is always making you two promises with a whole life policy. The first is to pay that death benefit out if and when the insured dies anywhere along the way, as long as that policy is in force. And the second promise is to have a cash value that's equal to the death benefit guaranteed at the age of maturity, which is typically age 100 or 121. So because of that, the insurance company is required to stash away more and more cash every single year. So these policies are naturally efficient. They're naturally going to accumulate more and more cash along the way. And as the policy owner, you have access to more and more cash along the way. It's basically a piece of the death benefit that you're able to access while you're alive. And if you take advantage of that opportunity, it's a great thing, right? So that's on a guaranteed basis. Everyone under the sun with a whole life policy has access to that. But if you have a mutually owned life insurance company that your policy's with, you have the opportunity to earn dividends, right? And the dividends are a form of profit. And when you add that into those guarantees, right? So you'll get your guaranteed cash value increase, and then you'll have a piece of what they call paid up additions or paid up insurance, right? There's another pool of cash in there that's also going to be earning interest within your policy, which makes everything much more efficient. Why? Because as long as that money lives in the policy, it's able to grow and earn interest and not be taxed. It's a tax-free environment as long as it lives in this policy, which is really a great benefit, right? So you're able to access it on a tax-free basis through the loan provision, and you're not interrupting the growth within the policy by doing so.
Yeah, because it's a collateralized loan. But so now let's talk about, well, how does the insurance company make a profit? So when they're designing policies, and the people who design those policies are called actuaries, when they design a policy, they assume that so many people will die. And insurance companies are really good at overestimating how many people they assume are going to pass away.
They're like engineers for life.
Yes, and as we know, engineers overbuild everything.
Thankfully.
Exactly. So the point is, if they say 3 people are going to die, let's say this year, and only 2, they've saved money. That's called savings on mortality. So that's one component of the dividend. The second component is they assume there's going to be a cost on an annual basis to run and operate the company. That's called an expense load. And if there's savings on expenses, and again, the insurance company is going to overestimate what it's going to cost to run the company, those savings go into the dividend bucket. And then the final piece is the interest rate that the insurance company is earning on its assets. And they assume a lower interest rate than they're normally getting. And consequently, if there's excess earnings, that goes into the bucket. And all of those savings on mortality, savings on expenses, and excess interest create the dividend. And here's something that people really need to know. A lot of companies talk about our dividend interest rate is 6.5%. Well, who cares? Because the interest rate on the dividend portion is one of 3 components. It doesn't necessarily matter. Let me give you an example. If there's no savings on mortality, meaning more people died than they estimated, and if there's no savings on expenses, meaning it costs the company more to run the company than they had estimated, and you get a 100% rate of return on your dividend interest, you got no money growing at 100%. So 100% times 0 is still 0. So all 3 components are important. But we get our eye taken off the ball by focusing only on the dividend interest rate. So when you take all 3 of those components, now you have the dividend, now you let it reinvest back into the policy, and then those dividends create more dividends. So that's where you get this, we call it perfect compounding.
So as those dividends grow and accumulate, again, you have access to them along with the guaranteed cash value that you're able to use all throughout the life of the policy as they accumulate. You could use them to supplement your retirement income. You could use them to take advantage of investment opportunities. There's really no limit as to what you're able to use a policy loan for. And then ultimately, it's also building a bigger piece of death benefit to pass on as a legacy to your family, to your charity of choice, to your business. So it is not single fold with just the cash value piece. It's also a piece going towards the death benefit, which makes everything as efficient as possible, right? So you're able to build up a pool of cash that you have full liquidity, use, and control over, then ultimately pass on a tax-free basis. It's a win-win situation. And if you'd like to learn more about exactly how to put this to work for your specific situation, check out our website at tier1capital.com and schedule your free strategy session today. We'd be happy to chat with you. Also, if you like this video, be sure to check out these 2. We picked them out special for you. Give us a thumbs up and hit that subscribe button.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.